Rohr here with an early concise highlight on Wednesday, October 29th, 2014. It's currently 6:45 a.m. U.S. Central Time, and it's going to be concise today because we're only covering the equities. The other asset classes are quite steady from our major global view from Tuesday morning. And things are going to be a bit stuck today in any event because everyone gets to play the financial community's favorite game, waiting on the Fed. That's at 1 p.m. this afternoon. And of course, there are quite a few other macro factors that are affecting the market right now. And what does that all mean to the markets? Well, of course, the fact that the Fed is expected to maintain the considerable time on the accommodative interest rate level is assisting the equities. And we have to add the other macro factor that's starting to loom large is something we have referred to in our write-ups, but not mentioned in the video so far, and that is the looming U.S. midterm election next week, Tuesday, where there's a lot of confidence being placed in the Republicans gaining the Senate and that turning things better over here. Frankly, we doubt even if the Republicans take the Senate, it's going to make all that much difference, but the market psychology will feed on that for now. And in terms of the actual market movement, of course, once we gapped higher yesterday on the S&P, this is, of course, the hourly chart on the left, 30-minute on the right, as usual, we had noted that, number one, this meant the negation of the aggressive up channel nominal down break that we went through a little bit later in the morning back on Monday. And that, of course, being nominal, needed to see further downside follow-through, but it never really got below the 1945 tolerance of the 1950 to 55 resistance. And that means now on any pullback with a negated down break at 1957.5 and a gap up from just about the same level from Monday's close yesterday, that is going to be good support initially and still allow for even all the recent and, of course, historic congestion in the 55 to 50 area to hold into any break. So we have technical reasons why any near-term sell-off, at least the first one, will probably hold in pretty well. And the S&P is trading $4 lower at 1976 today. But the problem with that is that 1975 to 78, as we had noted previous, was one of those historic areas that the market managed to overrun on last night's close. And that is part of it also gaining further strength, as we had noted that yesterday, that any push above the to a new high, any sustained push above 1950 to 55 was likely to put the hourly MACD back out above its upper runaway band, which it did from fairly early in the morning yesterday. So this is another bullish bias. The extended resistance is going to be up into 1985 area, the actual July trading high, from which it, of course, failed back down to 1900 before regaining its footing back into early August. And there was a gap and a down break up in the 1999 to 2004 area that is the highest of the outright technical breakdowns in resistance. The actual trading high, of course, was up here at 2012.5 on the December contract. That was actually just after the September contract expiration and very close to the lead contract 2013.5 level. And so that pretty much does it for the short-term view of the S&P 500.